The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Ben Boulos. These are your headlines. Mixed messages. Iran denies negotiations with the US as President Trump announces a 5-day pause on strikes against power plants and energy infrastructure and claims the deal is close.
We're giving it 5 days and then we're going to see where that takes us. And I would say at the end of this period, I think it could very well end up being a very good deal for everybody.
And yet oil prices rebounding now, as you can see, trading $102.66 a barrel. This after the president's initial comment sent Brent to its first sub-$100 settle in almost 2 weeks, whilst futures in the equity market pointing to Europe and the US giving back some of Monday's gains.
Apollo curbs redemptions from a $25 billion private credit fund after investors seek withdrawals of more than 11% of the total, following its first monthly loss in more than 3 years. Double Line Capital's Jeffrey Gundlach airs a note of caution.
The war and the action in the oil market has taken some of the headlines. The private credit market remains very murky. We've got all these investors that want to get out, and they can't get out.
Iran has denied talks with the US took place after President Donald Trump hailed productive negotiations with Tehran and ordered a 5-day pause on strikes against Iranian power plants and energy infrastructure. Well, Mr. Trump spoke to CNBC's Joe Kernan yesterday, saying that Washington is very intent on making a deal with Iran. However, Iran's parliament speaker dismissed suggestions of talks, saying fake news is being used to manipulate markets. Speaking in Memphis on Monday, Trump said he thinks Iran means business with this round of talks.
We've had very good discussions, very, very good discussions. And you have to understand, I know my whole life has been a negotiation, but with Iran, we've been negotiating for a long time. And this time they mean business. And it's only because of the great job that our military did is the reason they mean business. They want to settle, and we're going to get it done, I hope.
Dan joins us with more. Dan, our next guest is going to be talking about the fog of war, the fog of words and the fog of intent and the fog of actually what's going on. Just tell us how it feels, what you know on the ground.
Well, Steve, you can add the fog of negotiations to that as well. President Trump has seemingly stepped back from the brink in the last 12 hours here, at least for now, postponing these threatened US strikes on Iranian power plants for 5 days and citing what he calls very good and productive talks aimed at a total resolution of the conflict. It's understood that envoys Steve Witkoff and Jared Kushner reportedly conducted talks Sunday night with what Trump called a respected senior Iranian official, but who that is remains to be seen at this point. And of course, as you mentioned, Tehran also pushing back hard here. The Parliament Speaker Mohammad Ghalibaf dismissing Trump's claims as fake news designed, he said, to manipulate the oil markets. Interestingly, though, Politico also reporting today that Ghalibaf himself is being floated as a possible contender as a future Iranian leader. So those reports clearly suggesting that while he is being perhaps viewed as a front runner to take over from the missing whereabouts still unknown Ayatollah Mojtaba Khamenei, obviously those negotiations and those conversations continue. Meanwhile, inside Israel as well, Prime Minister Benjamin Netanyahu also making clear that there is no ceasefire on his horizon. Netanyahu saying strikes on Iran and Lebanon will continue as he seeks to safeguard, he says, Israeli interests in any potential peace deal here as well. And then, of course, we're following developments inside the Strait of Hormuz too. The U.S. Energy Secretary Chris Wright right, telling CNBC overnight that Iranian control of the Strait of Hormuz is an unacceptable outcome. Here in the UAE, the ADNOC CEO, Dr. Sultan Al Jaber, also weighing in. He went further, calling the blockade economic terrorism against every nation, and also warning there's only one solution, which is to reopen the strait. The president was also asked who could be in control of the Strait of Hormuz if and when it reopens. He suggested that he could be, or it could be a group of other partners, but at the moment the market still has no real clarity on exactly what that is going to look like. And then of course on the ground as well, the war also showing really no signs of slowing down at this point or pausing. We heard heavy airstrikes being reported in Tehran overnight, targeting the Iranian Ministry of Defense and IRGC headquarters. Blasts also being reported over Jerusalem following Iranian missile fire. And the UAE, Kuwait and Saudi Arabia all reported intercepting additional Iranian drones and missiles as well. What's also interesting is the Wall Street Journal reporting today that some Gulf states are now actively considering getting involved in this conflict as well. Of course, that report perhaps being compiled before President Trump suggested this diplomatic off-ramp here and negotiations underway with the Iranians. But nevertheless, it really highlights just how concerned some of the Gulf Arab states are and the Gulf leaders are with Iran's ongoing threats and attacks towards their critical energy infrastructure, and also reflects the mood of the region, also now seeking an off-ramp to this conflict, which has been ongoing for 4 weeks now. Back over to you.
Dan, thank you so much. So many points there to raise. Let me come back to markets, because there's no doubt the last 24 hours dramatic in terms of some of the market moves. We saw it on equities, we saw it on foreign exchange, we saw it on bond markets, and of course in commodities. Now the Asian markets picking up on the back of some of those big swings on markets yesterday, and they are bumping high. And that is again the mood music shifting around what we saw yesterday, the pause around the threats from Trump and postponing some of those threats for a few days. The market now hoping we might be seeing some sort of a taco trade here, the worst case scenarios that can be avoided on markets. And as a result, we've bumped higher. The Nikkei is up 1.4%, stronger moves across on the Hong Kong market. And don't forget, that was moving aggressively yesterday as the market first up Monday morning was again nervous that we were looking at some endurance in this conflict, and we saw aggressive selling in parts of the market from Hong Kong to South Korea. So today we're looking at a bounce in those markets. Where we've seen a lot of the action has been in commodities. WTI, Brent, we were down roughly 10% yesterday as the market again recalibrated around this pause. And what we've got this morning, we've snapped higher again. We've been up more than 4%, currently about 2% at this level. Gold prices, again, we're deeper into bear market territory. The levels we've come off since the end of January, 5,594, so just shy of 5,600, all the way back to lower levels than this. But in the current trade, 4,410, so somewhat stable in the morning session. Silver prices also modestly firmer today. Well, European markets and the wild swing, we certainly saw it in Europe yesterday. We fell aggressively out of the gates first up in the Monday trade, and then we're actually much higher in the trading session. We gave some of it back by the finish to the point where the DAX was up 1.2%. And the FTSE 100 was actually slightly weaker. This morning, as we look to get going, we're chasing a FTSE that leans into positive territory versus the DAX that gives back some territories, the early signals, but very bumpy that ride yesterday. We certainly snapped higher on the back of that post from Trump around the reaction around the Strait of Hormuz and putting a pause on that 48-hour window. Well, US futures, the market yesterday, very strong action too. We saw it in the pre-market and the futures first up on the back of the post. We saw it first up in the first couple of hours of trading. Some of the gains not sticking late into the session, although the market was still up 1.4% on the Dow. The Nasdaq up about 1.4 as well. So the market certainly reacted to pricing out some of those worst case scenario situations in the hope that perhaps there could be a resolution. Perhaps there was a door open to an off ramp. The signals this morning keeping the market supported, as you can see, but in slim ranges still, Steve.
Saudi Arabia and the UAE are reportedly moving closer to joining the conflict against Iran, according to the Wall Street Journal, which spoke to sources who said Saudi Arabia's Crown Prince Mohammed bin Salman is keen to re-establish deterrence, whilst the UAE is starting to crack down on Iranian-owned assets. Let's take a very quick look at Brent over the last 2 days. Last day was just quite extraordinary. I mean, that move that we saw just after 11 a.m. on Monday. Extraordinary move, and of course was precipitated by some interesting action in the markets, or so sources are telling us. Anyway, let's have a look at where we are going next, because the Energy Secretary, Chris Wright, told CNBC he believes conflict with Iran will eventually lead to lower prices.
My appeal to the American people is we've had 47 years of threats from Iran, which have artificially raised energy prices for decades. We're going through a short-term period of disruption right now, but the long-term benefits will be enormous. Think of years ahead and decades ahead. For you and your children, you're going to see a much better world. You got to get through a few weeks of disruption, and we're doing everything we can to mitigate those disruptions.
Which I find extraordinary, that the US price of diesel and the US price of a gallon of gas, the Energy Secretary is saying, was where it was beforehand because of Iranian threats. I find it extraordinary, but what about the experts? I'm going to ask that question to Bjørn Schildrup, who is a Chief Commodities Analyst at SEB. Bjørn, nice to see. Having studied oil markets for my entire career one way or other, first as a trader, then as a reporter, I find that statement very hard to believe, that US prices paid by Americans are determined in any way, shape or form by Iran, or certainly before this conflict anyway.
Well, I mean, what we know is that gasoline prices at the pump in the US is now at $4 per gallon, and much higher before the war. And also diesel prices are shooting through the roof. And in Europe now they are more than $200 per barrel of diesel. So, well, I mean, it has been a trouble in the Middle East with Iran for 47 years, that for sure. But that has sort of lifted the prices more than what we see now due to the war. No.
Sorry, you're saying that the pre-war price of a gallon of gas, which was somewhere in the region of $2.90, I think it was $2.95, something like that, on the average, it would have been lower had there not been tensions with Iran that have been bubbling over for... No. Okay, all right. Let's just get to the 21st century and what's going on now rather than 47 years of history. The market has repeatedly been very sanguine and I actually think very calm by and large. The reactions, and we kind of peaked at somewhere just south of 120, then we got to 112, and then yesterday we got down to sub $100 a barrel from the Brent close as well. Do you think the market's pricing in the risks correctly?
Well, I think, in my view, at $112 per barrel, which we had yesterday, I think the market priced in total closure or current closure of the Strait of Hormuz all to the end of April. No major damage to oil and gas infrastructure through that month beyond what we have now. And then some kind of benign outcome after that, in terms of loss of barrels from the Strait of Hormuz. That is what I think was priced yesterday. So in a way, yes, quite benign pricing. But I think the reason why oil is not just going through the roof is, of course, because we have huge buffers. Yeah. Right. When you really get the tight spot in commodities, no matter which commodity, they go 2, 3, 4, 5x normal price.
To your point around some of the complexities here, I think it's fascinating. The market reacted yesterday as though there's a stop-start button, and they got the good news from Trump as they saw it in terms of the post. But if you look between the lines and read between the lines on some of the detail here, negotiations are going through intermediaries. So it's not as clean cut as two people sitting down having a negotiation. We know when other people involved, things can go dramatically wrong and become much more complicated. There's that factor, but also the negotiating tactics from the Iranians now demanding certain things, no further attacks. And we know that Israel and the US may want to keep that on the table as leverage down the track. The other part about a fee that the Iranians want for running the Strait of Hormuz. I mean, just talk to us about the complexities here.
Well, I think the demand from Iran are quite understandable. They made an error last summer by not retaliating forcefully, making it cheap and not costly to attack Iran, and then like 9 months later they are attacked again. So this time they need to make it expensive and costly both economically and politically to attack Iran, to make deterrence. That is their weapon, so they need to close the Strait of Hormuz so that it has an economic and political consequence for the US, for Donald Trump, and for the midterm elections. That is my point of view. And what really matters here is who is in control on the ground in Iran. Is it the hardliners, or is it a more benign faction, and maybe there are several factions where Trump is negotiating with one faction and the other is talking to media and saying there are no negotiations. I mean, I don't really know what's going on the ground in Iran. That's the problem.
Well, that was one of the issues that was cited yesterday, knowing who to negotiate with. It wasn't that obvious from the American side who they should be talking to. So when we think about that and the scenarios the market has now priced, how are you thinking about how investors should be keeping some risk exposure in case this gets sorted versus still being very careful in case we're talking about a drawn-out conflict or an oil price that is not going to self-correct anytime soon?
Well, I mean, I think the markets in general, at least our strategies, have been waiting for a taco, waiting for Donald Trump to pull back from the brink. And we did see that yesterday in some sort. Was it Brent crude at $112, S&P 500 below the 200 moving day average, 10-year rate at 4.4%, gasoline above $4 per gallon? Was that the pain point of Donald Trump? That is the brink where he pulls back. So I think that is information in itself. This is the pain point probably or possibly for Donald Trump, where the economic and political cost becomes too great. So that in itself has a value for the market. But I think, it's if we assume that it's the hardliners that's still in charge in Iran, and it looks like that, when they were attacked, their oil and gas infrastructure was attacked last week. We saw them retaliate immediately at Qatar gas infrastructure, Ras Laffan, with serious damage for several years to their infrastructure. So, my assumption is that it's still the hardliners who are intact. They need to show that their oil weapon is forceful, has real consequences. And I think the real consequences, we haven't really seen them. It hasn't been a real consequence for the US and Donald Trump yet. Brent crude at $112 per barrel, give me a break. That is not a painful price for a month or two for Donald Trump doing this. I mean, the historical nominal peak of oil prices back in 2008 was $148. If we don't go above that price, what the joke the oil weapon is in the hands of Iran. That is such a defeat for Iran if they cannot really, even if they use their most potent weapon against the US, against the world, and they cannot even get the oil price up to that. That would be a defeat for Iran, I think, and basically show there is no risk of attacking Iran in the future.
Bjorn, to that point, that this has been described as the biggest energy disruption the world has seen, biggest energy disruption in history. And yet, as you point out, the oil price perhaps doesn't reflect that when you talk about Brent crude and light crude. Is a more accurate reflection of this when you look to the price of things like Omani crude and Dubai crude, which normally trade at a discount to the others, but are now touching $160 a barrel? Is that a warning about what the actual on-the-ground practical realities are that should be reflected in the Brent and light crude prices?
I mean, the only reason why we are still just trading slightly above $100, $103 today is because we are living off the buffers. Right, we're drawing down the buffers day by day by losing out on 12, 15 million barrels per day out of the Strait of Hormuz. So once they are drawn down to the point of the pain, that is when oil price goes 2x, 3x, 4x, 5x. And we're not there yet. So the market is basically assuming that we have sufficient inventories to sustain this crisis until it's solved. That is the main assumption, that it's not going to last. Yes, maybe it's going to last through April, but that's it. And on the question of Oman at $160, I think there are some technicalities in the pricing of Oman that is it's difficult to use it as a good guidelines. But, in a way, yes, $160, that is where Brent crude is heading if this goes on. And I think if we have this current type of disruption to the Strait of Hormuz, all the way to July, then the natural price of Brent crude should be $175.
Bjorn, forgive me if this is a naive question, but every time I hear 20% of the world's oil passes through the Strait of Hormuz, in my mind I think, well, that means 80% doesn't. Is there any way to ramp up more of where that 80% is coming from?
Well, I mean, most oil producers, they produce at max all the time because they utilize their oil equipment, their oil installations, their capital equipment all the time, fully. That is the most natural thing to do. So the only ones who keep spare capacity at hand is the Middle Eastern countries, now locked up within the Strait of Hormuz. So yes, you can increase production over time, but that requires capex spending. And US shale typically has a lead time of a year to increase production. You start out with increasing drilling, and then eventually you increase fracking, and then you increase production. And maybe you need some more pipelines to get that oil to sea as well, right? So it's a long time, but in a year, production will go up. But in the meantime, in the short time, in the nearest 6 months, we're going to live off the buffers.
Okay. Bjarne, thank you very much. Bjarne Schildrop, Chief Commodities Analyst at SEB. Thanks for being with us on the show. Still to come on the programme, Carolyn's been speaking to Kuehne and Nagel on how the shipping and logistics sector is navigating the Middle East crisis. We will bring you that interview. Plus, after decades as the world's reserve currency, is the US dollar losing its dominance? And could the euro take its crown? We'll discuss that. And is the economic environment forcing some private tech names to rethink their IPO plans? We will speak to the founder of one of the big firms tipped to go public. That's Databricks, and that's coming up this hour.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. Chicago Fed President Austin Goolsbee says he could see the Fed either cut or hike rates this year, telling CNBC nobody can tell the central bank what will happen with the conflict in Iran.
Through 2025, we experienced another inflationary shock, people complaining about prices. We stopped making progress on the inflation front, and at best it stalled out and started inching its way back up. So we've been waiting for that to have proved transitory, to have gone away, and to pile a new inflation shock on top of this before that one has left the scene. This is going to be a tough moment.
Guy Miller is Chief Market Strategist and Head of Macroeconomics at Zurich Insurance and joins us now. Guy, Austin Goolsbee says there could be a hike, there could be a cut. What's your reading? What's your take on it? What do you think?
Yeah, good morning, Steve. I mean, I think we're back to the old days when actually investors had to try and predict what the Fed was going to do rather than being spoon-fed the outcome. So in some ways, I don't think it's a bad thing. My feeling is that the Fed are on hold for quite a prolonged period. I think that in the US, we've got a situation where the US economy is actually quite robust. If you look at the labor market data, you look at the growth dynamic, it's still good. We've got a tech cycle. And of course, we've got the big, beautiful bill that really has still to kick in the first half of this year. So I think the growth dynamic is decent. The question will, of course, be, will inflation start to pick up, and will they look through the headline rise that we're bound to see given the higher energy prices? I suspect they're going to be on hold for the remainder of this year, and then we do have to literally wait and see what happens in 2027.
And do you think any of this, the situation in Iran and the energy price shock, changes what we can expect from Kevin Warsh when he takes over at the helm, once approved?
Well, I think below the radar, I think we forget actually Kevin Warsh has been nominated, and that's a positive for the markets. He's a known quantity. He believes in the independence of the Federal Reserve. He has a history at the Fed, which is slightly actually on the hawkish side as far as the balance sheet is going. So I think what is under-mentioned is actually that the nomination is a strong nomination that we've got for investors. When he takes over, of course, we know the dynamics play out differently depending on the data that we're seeing. But I'm not really expecting a great change in the workings of the Fed once he indeed finally does take over.
Karen, jumping in, bond markets had a wild ride yesterday on the back of the social media post from Trump. They were looking at the scenario that, look, we've got inflation moving aggressively thanks to the oil price, second run effects potentially, and now maybe we don't have that scenario. How are you thinking about just the volatility that came into the mix and how policymakers are going to have to keep recalibrating around every social media post?
I think it's interesting, Karen, that, the MSCI World Index is off about 6% from its high. The S&P 500 is only off 5.5%, given all that we're seeing. But you're right, the volatility has actually been in the bond markets. We saw 10-year gilts get above 5%. We've seen movements across the board there. I'm just surprised at how volatile they've been and how volatile Fed and central bank pricing has been. We've gone from expecting 2 rate cuts, according to the market, by the Bank of England just 3 weeks ago, to pricing early yesterday 4 rate hikes. To me, that seems rather schizophrenic, and I think it's going to be a long way off from some of these higher prices that we've been seeing. We also have to remember that the bond market itself does act as a bit of a constraint, and as we get yields up to these higher bounds, I think that has an impact in terms of the growth dynamic, and investors will start to think about, hang on a second, we've got a higher funding cost there, that will slow growth, and that will remove some of the longer term pressures perhaps on inflation. So I think that's the balance that investors are juggling with currently.
I want to pick up on that point because I am meeting with a whole bunch of central bankers in a matter of weeks, and I still don't know what question I'm going to be asking them, whether we're talking about rate hikes when it comes to the ECB, or to your point, whether there's a change. Because, look, we've had the whole first stretch of this year now filled with uncertainty because of the conflict. So even if we get a flip around the inflation scenario, that uncertainty could undermine the growth profile when it comes to Europe, at least. How do we think about that change in scenario, and that, in fact, if this settles down soon, we might be back to another case scenario where we're talking about more rate cuts being required?
Well, look, I think central banks need to be data dependent, as they keep pointing out, and I think there's more cause for that now than ever. What I was more concerned about was that there was a legacy impact from what happened in 22, when it was believed that, of course, the central banks were too lenient. That T word kept cropping up about transient in terms of inflation. And my concern was there was an issue that they didn't want to make the same mistake twice. And the trouble is, if you have that legacy and you're fighting the previous battle, the danger is you could make an error in terms of your policy. But I suspect the composition of most of these world central banks is such that they will look at the data, they will think, is this the right thing to do looking forward for the next 6 or 9 months? So I'm less concerned about mistakes being made, and I would hope, if you were asking them the question, you would get the feeling that they weren't fighting, the battle of 3 or 4 years ago.
Guy, I take on board your comments about the schizophrenia in the pricing of future interest rate scenario. If they are wrong, and having gone from 2 cutting to 4 hikes in London and obviously similar elsewhere, if they are wrong, is the equity market also pricing its valuations wrong on the back of what we're seeing?
Steve, I don't think so, because I'm more concerned about complacency in the equity markets generally. As I said, we're not even close to a correction in the S&P 500 or the World Equity Index, which of course is round about 10%, and we're certainly a long way from a bear market. What my concern really has been in equities is that investors, we've all been conditioned in the last 12 months from a change in policy, a change in the geopolitical narrative, and investors have been whiplashed. If they were being too defensive, if they were cutting back positions, they were whiplashed because of a change in policy. The market responded a bit Pavlovian, dog-like, and we've moved higher. But I think this time is different, because the difference between now and then was the various geopolitics and political moves had very little impact actually on corporate fundamentals and margins and earnings. This is different. We're going to see higher input costs. We're going to see higher energy prices. We're going to see growth at the margin a little bit lighter. And of course, you mentioned about the bond markets. Funding costs, whether it's government bonds or corporate funding costs through spreads, are rising. So the difference this year to the last 12 months has been this will impact corporate profitability. Even if it's modest, we should not be trading at the same kind of levels that we were at 7 or 8 weeks ago.
Absolutely, and I concur, Guy. But the fact of the matter is, in a world where we're not sure about the bond markets anymore and the fiscal largesse on all sides of the world as well, why wouldn't we pick the brightest and the best in the equity markets and use that as our safe haven? When the credit markets are concerning, the tech stocks are concerning, the bond markets are concerning, gold is oscillating all over the place, why not pick the best run companies and use those at this cheaper valuation to build up a portfolio?
Well, I think that's exactly what we've been seeing, Steve. Really, for the last 9 months since the summer, we've seen investors rotate within technology, for example, even within the United States. We've seen them rotate across regions. We've seen them move out of the high-value US tech stocks into Korea and other parts of the world. What I'm seeing is that's what's happening. We're not seeing any money actually leave the market in any kind of scale. So they are buying the most predictable, the best value, the companies that have the strongest balance sheet. To me, that absolutely, as you say, makes sense. But if we're in a world where actually the markets generally are going to be under pressure for some time, I think just at the margin, putting something in cash right now, because I agree bonds aren't particularly attractive, commodities aren't particularly attractive, but taking something off the table I think would be good to have in your back pocket, because I do think there's going to be a better entry point in the weeks ahead.
To that point, Guy, just a quick one. Do you think the market was looking at a classic taco trade yesterday that Trump always chickens out?
Yeah, look, I absolutely think that. And I think, the people I speak to, they all say to me, oh, don't worry about the red on your screens because it's going to bounce. And I think that's the view. We've all been waiting for this to happen. And I think, to be fair, yesterday was a clear indication that he wants out. Now, my issue with that is this is not like the tariffs where he had full control of turning them up or turning them down. It wasn't like the clinical precision that we saw in Venezuela or even in terms of the clear intent in Iran last June. Even if he wants to get out, I think there is risk to this. And a lot of collateral damage has already been done. So I would agree that the market will look to move higher if indeed we see true negotiations underway, which I'm still skeptical about. But I suspect even if that happens, there's not going to be the same kind of profound move higher and bull market rally back to new highs, at least in the near term, that we might have seen just a few months ago.
Guy, thank you so much for joining us and taking the questions. Guy Miller, Chief Market Strategist and Head of Macroeconomics at Zurich Insurance. S&P 500 and oil futures saw a sudden burst of activity just before 7 a.m. Monday, about 15 minutes before President Trump posted on social media that the US had held talks with Iran and was halting plans to strike Iranian power plants. An announcement which saw equities spike and oil decline. You can check out that full story on CNBC.com. But it was fascinating to see the reaction. Some say couldn't even go for a coffee break. I think if you'd slept in yesterday, you also would have missed a lot of the action.